Microsoft trades at approximately $451 per share for a market value of $3.3 trillion. At that price, our reverse DCF implies approximately 20.3% annual unlevered free cash flow growth for the next 10 years. That price implied path takes estimated unlevered free cash flow from $67 billion today to $422 billion in year 10, 6.3 times the current level. Over fiscal 2022 to 2025, reported free cash flow grew by 4% per year. That is the delivered record beside the price implied 20.3% annual path. Can Microsoft sustain this, or is too much growth already priced in? To answer that, we run the valuation through three lenses. A reverse DCF reveals what the current price already assumes. A traditional DCF estimates what the business could be worth under bear, base, and bull scenarios. And a price-to-earnings multiple adds context from comparable historical and market anchors when those are available. Three lenses, one conditional verdict. We model Microsoft's cash engine as customers to ARPU to gross margin to free cash flow. The template's proposed defense is switching costs. Once a company runs its operations on this platform, ripping it out costs more than staying, and that is what protects the margin. For an upside case to hold, four things must be supported: seat and usage growth, pricing power, margin discipline, and return on capital. We will test each one later. Microsoft stock has materially outpaced the market. That helps explain investor enthusiasm, but not whether the current price is justified. Over the last 3 years, revenue grew approximately 16.1% a year, earnings per share grew approximately 22.8% a year, and reported free cash flow grew approximately 4% a year. One gap stands out. Earnings per share grew far faster than reported cash flow. The remaining gap can reflect working capital, cash taxes, capital spending, and accounting timing. The data here does not assign it to one cause. Because this model values estimated unlevered free cash flow, that is exactly the gap we have to watch, not the headline earnings number. Reported free cash flow margin moved from 28.1% in fiscal 2022 to approximately 20.2% for the latest trailing period. In the quarter ending June 2026, revenue grew 17.7% year over year, broadly in line with its recent trend. The question is whether that continues. The capital behind that growth has earned well. Our accounting estimate puts Microsoft's latest normalized ROIC at roughly 29%, comfortably above the 10% cost of capital. You can see it on the chart. The stock materially outpaced the broader market over this period. That relative performance is useful context for the valuation, not proof of fair value. But recent growth is the starting point of this analysis, not the forecast. The question is never what was delivered, it is what the price now requires. At the time of this analysis, Microsoft trades at approximately $451 per share for an equity value of roughly $3.3 trillion. Estimated trailing unlevered free cash flow is approximately $67 billion. A traditional DCF starts with forecasts and calculates a value. A reverse DCF does the opposite. It takes today's value and solves for the growth rate that makes the price possible. We use a discount rate of 10%, the company's estimated cost of capital, terminal growth of 2.5%, and the company's estimated unlevered free cash flow base. The result, on these assumptions, today's price implies approximately 20.3% annual unlevered free cash flow growth over the next 10 years. The market's math under our assumptions, not a fact. And the required growth remains demanding. Across reasonable discount rate and terminal growth assumptions, the hurdle stays high. That growth path takes unlevered free cash flow from $67 billion today to approximately $422 billion in year 10, 6.3 times the current level. Watch it compound. Year 1 already needs roughly $80 billion. By year 5, approximately $168 billion, each year building on the last with no year off. That target has operational consequences. Holding the current estimated unlevered free cash flow margin at 28.1%, Microsoft would need approximately $1.5 trillion in annual revenue by year 10. The market is not pricing in one more strong year. It is pricing in 10 years of sustained delivery. But does our own forecast produce the same value? Now I forecast the business itself. $332 billion of trailing revenue, and how much of it turns into unlevered free cash flow. The base path starts at 17.6% and fades toward 4%. That is trailing revenue growth blended with forward analyst consensus. Cash conversion has real room to improve, from 20.1% of revenue today toward 28.1%. With a 10% discount rate and 2.5% terminal growth, that produces $310 per share. About 58.8% of modeled enterprise value comes from the terminal value, so the result remains sensitive to long-run assumptions. The bear case starts at 14.8% growth and assumes cash conversion never improves at all, holding at 20.1%. It is worth $202. The bull case starts at 20.4% and reaches 30.2%, the best margin it has ever posted. It reaches $368. The width of that range is not our opinion. It is the spread between the highest and lowest analyst revenue estimate, and here they are, unusually close together. At $451, the stock sits above even our bull case. The DCF gives us a value. The multiple tells us what investors are paying for it right now. Our final lens is the valuation multiple. Microsoft trades at approximately 22 times trailing earnings. Based on expected forward earnings, that falls to approximately 20 times. The gap reflects the growth analysts already expect. The company's own median across 4 fiscal observations is approximately 35 times. The broader market trades at approximately 24 times on a configured trailing price to earnings benchmark. But notice the tension. On earnings, Microsoft looks inexpensive, yet measured against the free cash flow it produces today, our model says the price still demands extraordinary long-term growth. Cheap on earnings is not the same as cheap on cash flow. The valuation survives mathematically, but only if a few conditions keep holding. Now the evidence. Seat and usage growth is mixed. Revenue grew 17.7%, but the data does not isolate seat and usage growth. Pricing power is mixed. Revenue growth of 17.7% and reported free cash flow margin of 20.2% do not isolate pricing. Margin discipline is at risk. Reported free cash flow margin is 20.2%, 7.9 points below the oldest year. Return on capital is supported. Return on capital of roughly 29% against a 10% cost of capital. 1 of 4 is supported. Seat and usage growth, pricing power, margin discipline remain unresolved. The verdict remains conditional. Now stress the model. The business risks are growth saturation, competitive pricing pressure, churn in a downturn. The screen translates them into exact valuation inputs. First, cut starting revenue growth to 70% of the base assumption. Fair value falls to $252. Second, reduce the steady-state free cash flow margin by 20%. Fair value becomes $258. Third, raise the discount rate from 10% to 11%. Fair value becomes $269. Finally, combine all three while fading mature growth to the terminal rate. The model falls to $175. These are standardized model stresses, not predictions. They show which assumptions the valuation is most exposed to. These risks do not need to destroy the business. They only need to produce results below what the current price already requires. The standardized stresses show how the valuation moves. But before the verdict, there is one counter-argument this analysis owes you. One more test before the verdict, and one important counter-argument to answer first. On a normalized historical return of roughly 29%, Microsoft earns 19.1 percentage points more on its capital than that capital costs. Sustainable growth is roughly return on capital times the share of profit reinvested. Holding that share steady, the growth this price requires would require reinvesting roughly 70% of after-tax operating profit. So capital may not be the binding constraint. The harder question is whether it can be deployed at similar returns while revenue scales to the level this price implies. 2 caveats. That identity describes operating profit, not free cash flow, so it holds only while the reinvestment rate is steady, and a past accounting return is no promise about the next investment. That is the last piece of evidence. So what do all 3 lenses say together? 3 lenses. Here's the verdict. Lens 1, the reverse DCF. The price demands 20.3% growth every year for 10 years, an implied free cash flow path well above what the company recently delivered. Lens 2, our own DCF, $202 in the bear case, $310 in the base case, $368 in the bull case, and the current price sits above even our bull case. Lens 3, the multiple, a clear discount to its own median across 4 fiscal observations. The combined downside case lands at $175, a approximately 61.2% below the current price. Add the three together and the tell is clear. On earnings, the stock is not expensive. The multiple is no warning here. The pressure is all in the cash flow. Even our most optimistic scenario cannot reach today's price, with our base case roughly 31.3% below it. This is not a rich multiple story. It is a price paying for years of free cash flow growth beyond what even our bull case assumes. Microsoft is an exceptional business. The returns it earns on capital say so. What looks expensive here is the price, not the company. Our overall verdict, priced beyond our bull case. Business quality and investment value are different questions. This conclusion remains conditional on the evidence and assumptions shown. That is the analysis. Thank you for watching. This analysis is a valuation framework, not financial advice. The result depends on the assumptions shown, and you should always verify them and do your own research. Snapshot, July 31st, 2026, position not disclosed. The description lists sources, method, and AI use.